myself. Okay, so very, very important, right? Very, very important. You need to add back because you deducted the one you're preparing the P&L. You deducted the one you're preparing the P&L. Very, very key. Very, very key. Then for increase in inventory, if you look there, it says minus 15. What does it mean?
You bought more stock, so there was an outflow of cash.
Okay, so it means that you guys understand your cash flow. You guys understand your cash flow. So anything that creates an outflow of cash, it's actually going out. So minus anything that brings in cash is a plus. Very, very simple. Very, very simple. Okay. So that's what I wouldn't want to go into the nitty-gritties of operating activities, investing activities. I think that has been treated in financial management. Or what do you guys think? Do I have to go through again?
Yes, sir, I think so.
This question, I asked, I don't even know why I asked this question. Okay. So let me just go through the forecast again. Let me just go through again. So it begins with profit, right? And then you add back depreciation. Like our friend said, when we are doing our P&L, we deducted profits. We deducted depreciation, sorry. We deducted depreciation. So we need to add back depreciation as an adjustment. So when you are done with that, then you move on to your working capital. If there's an increase in inventory, it means that you bought inventory, and so cash went out. If there's a decrease in inventory, it means that you sold inventory, and so cash came in. So that will be a plus. In this case, it was an increase in inventory, and so it will be a minus 15 or minus whatever. Now, what about trade receivables? For trade receivables, these are people who owe you, right? So if there's an increase in trade receivables, it means that your money is with debtors or people who owe you. So that's a minus. If there's a decrease in trade receivables, it means that these debtors have paid you money, and so that's a plus. What about trade payables? If there's an increase in trade payables, that would be a plus, because it means that you are getting your stuff on credit and you haven't paid yet. So the cash is still with you. If there's a decrease in trade payables, it means that you've paid your suppliers or your payables. Very simple logic. Things like interest payment, tax payments, all these things represent cash outflows, and so would be minus. If there's a sale of non-current assets, when you sell something, you get cash, and so that would be a plus. If there's a purchase, that's an outflow. If there's a payment of a loan, that's an outflow. Payment of a dividend, that's an outflow. Okay, so what are operating activities? Does anyone remember what our operating activities are?
Can we say they form the usual operations of the organizations?
Fantastic. The normal business operations, the day-to-day activities of an organization. That's what they call in the ordinary course of business. That's how they call it, the ordinary course of business, or the normal business operations. Then what about investing activities?
I mean, it's usually for acquiring assets, basically acquiring assets or an investment. So when we talk about, yes, so acquiring assets or other organized, so like a subsidiary. So acquiring assets or subsidiaries.
Okay, so investing is basically acquisition. It deals with acquisition. It deals with things like acquiring a non-current asset or selling a non-current asset. Those type of transactions go under investing activities. It's pretty straightforward. Then for financing activities, can anyone explain that?
I think it focuses on the financial activities of the organization in terms of how to finance the company, either through debt or equity.
Fantastic. That's the perfect definition. Okay. So that's it with the cash flow forecast. Now there's something we call the revenue and cost estimation approach. It's nothing scary. It's just what we know as a P&L. So I wouldn't talk about it too much. Now let's move on to ethics. Ethics and financial management. Ethics and financial management. Just give me 1 second. Okay. I don't think this was supposed to be ethics. Okay. Anyway. Now, there's something we call, have we talked about stakeholder groups and their interests?
No, please.
Oh, we haven't done that yet.
No.
I see. Okay. So there are different stakeholder groups in an organization. So for you as an individual, okay, so let me explain what a stakeholder is. A stakeholder is someone who has an interest in the business or in the strategy of the organization, right? So anybody, whether it's a group, individual, who has an interest in the strategy of the organization is a stakeholder or has a stake. He holds a stake in the organization. So, for example, for you as a human being, there are people who are your stakeholders, right? Your parents are, maybe your school, there are people who have an interest in your well-being. It's the same logic when it comes to what do you call it? When it comes to organizations, same logic. Same logic when it comes to organization. Very, very important. So there are different stakeholders and they all have their own expectation and their own interests. So we have employees, right? Employees, what do you think is the interest of the employee in an organization?
Job security.
Okay, apart from job security?
Good working conditions.
Okay, apart from good working conditions?
Fair wages.
Okay. Okay, I think you guys have mentioned a lot. So you see, everybody has their own interests. Everybody has their own interests. And so it is this interest that fuels, that stake in the organization. Now you have employees. You also have customers. There are a lot of them, a lot of stakeholders. I think we've already talked about this. We've talked about internal stakeholders, right? Connected stakeholders and external stakeholders, haven't we? Haven't we?
We may have spoken about it.
Yeah, I think so. Anyway. Okay, so for customers are looking for value. That's their interest in the organization. They are looking for value. That's what they are looking for. That's what they are looking for. They are always looking for value. So customers have expectation about the nature of the goods they receive from a company. That's very, very important. That's very, very important. Then suppliers. Suppliers are looking for credit-worthy customers. Credit-worthy customers. They are looking for credit-worthy customers. That's what suppliers are looking for. They are looking for credit-worthy customers. So suppliers might expect to develop a good business relationship with the company and collaborate on achieving improvements in the value network. But most importantly, because suppliers usually would offer stuff on credits, they would want a good and credit-worthy customer. A good and credit-worthy customer. So that's something to always know. They also have community. The community also has their own interests. They expect that the organization will provide employment for those in the community. That's what they expect. That's what they're always thinking about and expecting. Then the government they are also interested in the fact that the company will pay their taxes and they'll comply with environmental standards and all that. It's very, very important. Now, there's something that you need to know, which is very, very important when it comes to stakeholder management. There are possible conflicts of interest that might result from this, right? Because if you're an organization, you are managing all these people or all these stakeholders, it's possible that a conflict might result. It's very, very possible. It's very, very possible. Okay. So shareholders will usually have an interest, right? And managers will also have their interest. What do you think the interest of the shareholder is in the organization? What is the interest of the shareholder?
Well, to see if the company is profitable enough to maximize their worth in the company.
Fantastic. That's it. That's it. So they are all for they want to increase their wealth and income over the long term. Managers too are interested in meeting short-term performance targets. You know, that's management's focus. That's management's focus. And why do they have this focus? In order for them to be able to get their bonuses, and their remuneration will usually be tied to these short-term performance targets. So you see there's a discord here. Shareholders want to increase their income over the long term. You know, managers want to get their short-term bonuses very, very quickly. So this is where the conflict of interest happens. This is where the conflict of interest happens. So that's very, very important. That's very, very important to know. And this issue, it can create a lot of problems. It can create a lot of problems. So agency conflicts. Agency conflicts are simply the differences in the interest of owners and managers. These are the differences in the interest of owners and managers. You know, some of these conflicts that might have a direct impact on the financial management of a company are as follows. You know, so it can have impact, as I said, on the company. So earnings retention, the remuneration of directors and senior managers is often related to the size of the company. For example, annual sales. This gives managers an incentive to increase the size of the company rather than to increase the returns to the company shareholders. When this happens, companies might invest in capital investment projects where the expected return is quite small, propose overpriced takeover bids for other companies. So you see, because there's a conflict between what the agents are the managers, you know, and the principal are the shareholders. Because there's a conflict between these two people, it creates some form of conflict. Very, very important. Very, very important. And so because of this conflict, managers also, you know, do things that favors them rather than favor the organization as a whole. You know, another thing is time horizon. We talked about the long-term, short-term thing, right? Shareholders are concerned about the long-term financial prospects of their company because the share price depends on the expectations for the long-term future. Managers might only be interested in the short term because managers, they are not going to be in the company forever. You know, it's not like they are going to be in the company forever. So they are not really worried about what is happening long term. They are looking at getting what they need to get and then moving on. Yeah. That's all they are looking for. That's all they are looking for. Okay. Then in terms of risk minimization, management might choose investment based on their impact on the total business risk of the company. However, this might not be in the best interest of well-diversified shareholders who would only be concerned with the systematic risk of investments. So in terms of risk minimization, managers, they might go for certain investments in order to get a high return. They might go for certain investments in the short term. That might not necessarily be a good idea for the company as a whole. A good idea for the company as a whole. So that's very, very important. Very, very important. Please, is that clear? Any questions? Any questions, please?
No, sir. No, sir.
Okay. Is it easy? So in the customer focus limited question, right? Who were the owners and who were the managers? Were they the same people?
Yes, sir. It was an owner-manager of a firm where the people managing, that's the three, was shareholders. However, the shares and percentage were different.
Okay. Okay, and then it means that you guys really, really looked into that case. Okay. Now more on this whole agency conflicting. This agency conflicting is a big, big issue. It's a big issue. So let's talk about it. Agency theory is based on the view that the system of corporate governance should be designed to minimize what we call the agency problem. The agency problem is what we talked about, that there's a conflict between shareholders and managers and reduce agency costs. So what we are trying to work at here is to align shareholder objectives with management objectives, or even the management remuneration system. Have you realized that for a lot of companies, I don't know about Ghana, but for some of these top companies, what they've realized is that to align shareholder objectives with management objectives, when you come in as a manager, they give you, as part of your package, they give you some shares in the company. I've forgotten the name. Excuse me. Like share options. So they give you some shares in the company so that it gives you the impetus to work towards the shareholder objectives. If the main financial management objective is the maximization of shareholder wealth, management could be persuaded to pursue that objective by granting them share options. Oh, so it's already here. Okay. So management would then be more aligned, be more motivated to increase the market value of the shares as much as possible. So they will be given that motivation to increase the market value of the shares. Very, very important. Very, very important. Okay. In an ideal situation, the agency contract between the owners and the managers of a company should ensure that managers always act in the best interest of the owner. Very, very important. So ideally, that's what should happen, but that's not always the case. And that creates that agency conflict. And one of the ways we talked about was where organizations use what we call share options. In the pursuit and In the pursuit of profits and shareholder wealth maximization, companies should act ethically. Companies should act ethically. So this is where ethics come in. When you are pursuing shareholder wealth, you should act ethically. You should deal with your clients with honesty and integrity. Everything should be out of integrity. That's very, very important. Okay, any questions on agency conflict? Because it's an important topic, so I want to be sure that it's well understood. Any questions on
As I said,
yes,
when
boss.
given the manager's share option, does it really solve the issue of the agency conflict? Because sometimes it may lead to, they know what the organization is going through. So probably they know that, okay, they've given them a vesting period of for like 3 years before they can exercise their right or their options. So, they can make it in such a way that by the third year, everything goes on well. Then share prices increase, they cash out, and from there, everything becomes worse. Doesn't it lead to more or less like something like insider trading or something like that?
Yeah, so it doesn't eliminate the problem. I think it's a hopeful solution, in my opinion. So I agree with you. It doesn't eliminate the problem at all, but it's only a hopeful. It's only a hopeful solution. It's only a hopeful solution. So it doesn't eliminate the problem. It just creates there's a hope that if you give them share options, then they would work towards maximizing the value of the company, which aligns with the goals of shareholders. But as to whether it really, really creates that, that's a different issue. Because some people, you give them the share options, they don't really care. They are not going to work, they are not going to work. Yeah, so that's also
okay.
true.
I would like to say that if the share option scheme is attractive enough, and then the performance target for the managers is also competitive enough, then it compels them to pursue that target in order to align their interest with that of the shareholders. That's what I think.
Sorry, could you repeat that again? I think that's a good point.
What I was saying is that he asked the question if that share option scheme eliminates the the conflict of interest, and I'm saying that if the share option scheme needs to be attractive enough, and the performance targets associated with the share option scheme should also be competitive enough, so that management's interest will align with that of the shareholders. I don't know if you get
Okay,
what
so basically what you are saying is that we should be using a mix of share options as well as remuneration systems that will align the interest of management to shareholders, right?
Yes, please.
Okay. So what you're saying is that share options alone cannot solve the agency problem.
Exactly.
Yeah,
So
that's true.
The share option is associated with a performance target. For example, you've given a share option to a manager, tying it with a performance target of, let's say, 1 million profit by the end of second year. So if the performance target is very competitive, it compels the manager to work towards achieving that in order to exercise his share option. In that case, um, within the span of years that that performance target has been set, the manager will work very hard to pursue and then achieve it in order to exercise that share option. And by doing that, it aligns his interest with that of the shareholders, which is maximizing the shareholder wealth. So it is not only about giving them just any share option. It needs to be really assessed and then offered. You offer the share option. It has to be very attractive to the manager to force him to pursue it. And then the performance target that is being tied to that share option also needs to be competitive, so that it forces the management to pursue it and then achieve that to be able to exercise that share option. So by doing that, it forces the manager to align with shareholders' interests, the long-term share share, what do you call it? Maximizing the wealth of the shareholders.
That's a very, very good point. So the agency problem is a behavioral problem. That's the first thing you should know. The agency problem is a behavioral problem. And when you are dealing with behavioral problems, you can't use a one-size-fits-all approach. So let's say if you have taken, let's say you have a child and the child is not performing at school, you cannot attribute it. Usually it will be a multifaceted problem. And if you want to improve the child's performance, you need a little bit of everything. And so that's the same approach when you're dealing with the agency problem. It's a behavioral problem. And so you need share options. You also need to look at the remuneration system. You also need to understand the terrain you are working in, right? So what motivates a Ghanaian will be different from what motivates an American or a Chinese. For example, if in your remuneration system, if it's all about share options in Ghana, people might not be too keen. But in the US, yes, because the stock market there is well developed. People understand shares. They understand the value that shares give. And when you tie people's benefit to shares, they might be willing to work harder. But in Ghana, it might be totally different. So it's a behavioral problem. It's a multifaceted problem. You need several tools to be able to at least bring it down. Totally eliminate it might be difficult because these are human interests. I hope it's quite clear. Okay. The reason I touched on that because it's a huge problem, and it's relate corporate governance and all that. It's very, very important to know that. Okay, so let's talk about investment decisions. Now, we cannot talk about investment decisions without talking about capex. So who can explain the difference between capital expenditure and revenue expenditure? Anyone knows the difference between, okay, if you can't explain the difference, what is capital expenditure?
Okay, so I want to talk about the difference.
Okay.
The benefits you obtain from capital expenditure, usually exceeds more than a year. However, the revenue expense, you can get the benefit from that expenditure within a year.
Okay, fantastic. Fantastic. That's a very, very amazing point. Amazing point. Okay. Okay. Oh, what's happening? So for revenue, for capital expenditure is spending on non-current assets, right? When you spend on a non-current asset, capital expenditure, some people call it capex. I like to call it capex because that's what I'm used to. That's what I'm used to, capex. That's what I'm used to. So capital expenditure is spending on non-current assets, such as buildings, equipment, or even acquiring a new business. In contracts, revenue expenditure refers to expenditure that does not create long-term assets, but is written off as an expense in the income statement. So basically here you are spending on stuff that is not long-term in nature. Like Caleb said, you use the 1 year threshold. If the benefits will accrue more than a year, capital expenditure. Less than a year, revenue expenditure. Very, very key. Now let's look at investment appraisal. Like I said, all this is theory. And when you go through the book, it's a lot of theory. But going through the plenty loads of theory might not necessarily benefit you. Might not necessarily benefit you. So what you probably need to do is look through past questions. So that's what we'll be doing. That's what we are seeking to do. If we have some time, I'm sure we'll get to it. Before capital expenditure projects are undertaken, they should be assessed and evaluated. That's what we mean by investment appraisal. Appraising an investment. Appraising an investment. As a general rule, projects should not be undertaken unless they are expected to provide a suitable financial return. So projects must always have a suitable financial return. That's very, very key. And if you are using NPV, the project should have a positive NPV or a positive net present value. Now, we cannot talk about investment appraisal without looking at the ways investments are appraised. There are different ways you can appraise an investment. You can use the accounting rate of return. You can use what we call the ROI. You can use the payback method. You can use the discounted cash flow method. You can use net present value, internal rate of return, discounted payback. All these are methods for appraising an investment. And it's important you understand them, understand how to apply them in the different scenarios that may be presented. So you can decide to use payback. So payback, for instance, is the time it takes for your investment to pay back. So if you, let's say, bought a car, an example, right, for 20,000, and you use it for Uber, right, you'd want to know how long it takes you to recoup your 20,000 Ghana.